So can you take, I don't know which one you can answer this, but can you take like a dead IRA account or an IRA account with a small amount and put it into a policy and then pay that policy and use it just, because the IRA account has fees and everything else, the policy has the policy premium. What other fees are included with the policy?
Just mortality expenses.
Mortality expenses. Death benefit, term costs, term insurance costs.
So when we said that you write that $10,000 check, it might be $500,000 death benefit the next day.
Mm-hmm.
All right, $10,000 has some mortality expenses that come out of there to cover that. All right, so they're almost buying insurance on insurance.
Right.
So you've got some mortality expenses, but that's it. There's no fees to borrow the money. There's no administration or anything like that. You just pay that interest.
So there's no yearly fees on the policy itself?
You might also be interested, if you've got the time, to talk a little bit about the possibility of tenants and investors.
Yeah, Dan stretched me a little bit. He called me and said, hey, I got an idea. I like ideas. What do you got? I've got rental properties. I've got tenants in the rental properties. Husband and wife. What if the husband dies and leaves the wife with the house? She may not be able to pay the rent. Dan's hurt. Got to go find another tenant. Go through all that. What if we had an insurance policy on the family that when the husband and or the wife died, and if the husband died, the wife would get the death benefit, she could pay off the house and buy it from Dan, self-completed.
Retail and heavily left over.
So you're the landlord and then,
So,
you'd like to see that be a wreck?
yeah, so this is big, this is big. Well, yeah, we can do that. Now, there has to be insurable interest, okay? In other words, Linda and I couldn't own a policy on Linda, okay? We're not related, we're not in business together, okay? They would never, the insurance companies would never cover that. I could have a policy on Rebecca, the business partners. There's insurable interest. Okay, now, I've got a tenant. Could I go get an insurance policy on my tenant? There's not really insurable interest there.
Well, the tenant could leave any time.
The tenant could leave any time, but we're trying to create the insurable interest, and it might be that the landlord and the tenant contribute to the premium. And we created insurable interest because with the agreement that's in place that if you die, your wife's going to get the death benefit covered. We're working on that. We don't have a policy yet.
Kind of called almost a key man policy.
It's almost a key man policy like in business. All right, key man policy. We're back in our business together. If she died, it would affect my business drastically. So I have to stand up here and talk about it. Yeah.
And so my thing, of course, don't ask, don't get, is can I have the tenant pay 100% of all that? Have a contract that works, because I really don't want to pull out profits from the business. And if the tenant's willing to, and we can do a contract, great, and then Commissioner want to do the same thing on the opposite side for the investor in case when the investor passes away, their son or daughter or whatever moves in with that insurance. So you're covering both sides, investor and.
I can see where you're okay if both of them are covered on the policy. If it's one, I was saying if it's one, like if you're covering the husband, the wife is going to be watching and vice versa.
Yeah.
That's it, yeah, it's like,
You know,
yeah.
so I had to say, how's your relationship?
Yeah.
Who does the cooking? So, yeah, that's kind of, he's stretching me on that one. I like it though, it's a great idea. I'll put it there.
I just want to make sure I understand, because I'm not really good with life insurance policies. I know I have one. I don't know whether I have the capability to do any of this within what I have. So did I just hear that you can or cannot roll an IRA into a, you cannot?
You can if you pay the tax first.
Right.
That's
Okay.
that was going to be my next
Post-tax.
question.
Remember tax law,
Right.
they got you guys.
So it's really only if you've got, cash that you want to fund an account to start.
Can I speak?
But you can come right up here.
Can you do a 1071?
Do what now?
A 1071
You can do a 72T.
in the IRA?
Tell us why.
Oh, please, yes.
Oh.
892A.
There's a provision in the IRS code, it's called a 72T, which says that you can access your IRA before you're 59 and a half if you take equal payments for the longer of 5 years or till you're 59 and a half. So let's say you have $100,000 in your IRA and you want to get access to the money now. Okay? So you're 54 years old and you start pulling out $5,000 a year. You have to do that for 5 years, remember, or till you're 59 and a half, whichever is longer. So if you're 54 years old, it's the same number, right? 5 years. All right? But what if you're 40 years old? Well, then you have to take out that money for 19 years. Now, what did that do for you? Well, you're only pulling out like $5,000 a year in this example, so you're paying a little bit of tax versus a whole bunch of tax. If you just say, forget this, I'm just going to take my whole $100,000 out, you get to pay all the tax in 1 year. So there are some things like that that we can do, but this is where I think our value is more important than even that. So who in here is inefficient with their money? Inefficient with their money. Inefficient. Not efficient.
Oh, now I get it, yeah.
You know, the thing about it is I've been doing this for 25 years and I've never found anybody that was totally efficient with their money. So I'm going to give you an example. Can you pull up the truth concepts? Okay. So, and I think I did this maybe in June. I can't remember because we change this up all the time. Don't we, Linda? Anyway, one of the things that Jim and I do, along with legacy planning, showing you how you can get at least 20% more in after-tax retirement income by putting this strategy as a part of your financial plan, not all of it, a part of it. And I have had to speak around the country on that with this the investor newsletter group that recommends me, okay? But the place that Jim and I really do our best work is we find money in your personal financial plan that you're using inefficiently. Now, that's money that's going out of your economy, right? It's gone, right? And if you are unnecessarily giving that money away, or unknowingly, and we can bring it back to you, show you how you can bring it back to your personal financial economy, then maybe we've created a pool of money that we can start using, right? Because you never had it anyway, right? So I'm going to give you a little simple example. Remember I told you my granddaughter, 10 years old, she'll be 10 in 2 weeks. All right? She was 2 weeks old. My husband and I bought a house. Now, Arkansas, I just so wish I could move my house out here. I have a friend in San Mateo, and he came to visit, and he goes, Becky, do you know what your house would be worth if it's in San Mateo? It's like $9 million. But in Arkansas, the 49th poorest state in the union, it's $550, $600. Okay? So, 10 years ago, bought the house for $550. 9 years ago. My granddaughter was 2 weeks old. That's important to remember. Called up, got proof of insurance from USAA Insurance Company. They faxed it to me because we fax back then, not email. And isn't it amazing how technology has changed so fast? Anyway, it was a $500 deductible, and it was $2,800 a year was my homeowner's insurance premium. All right? $2,800. Somebody remember that number? Called him back. I said, I would like to have a 1% deductible. 1% of $550,000 is $5,500. So what am I saying? If I have a claim, which I've never had since 1976, I've owned a home. You can do the math, I'm 62. I have never had a claim. But what I was saying is that if I had a homeowner's claim, I was gonna pony up with the first $5,500. All right? My homeowner's insurance premium went down to $395. Oh my gosh. That's $2,400 savings right now. Well, my granddaughter's 14 days old. Guess how long you have to wait to put a policy on a child? 14 days. So, $2,400, we decided we were gonna spend that. That's found money, right? That was money that was going out that now has come in. We wanna be honest with our money. So we said, we've got to put that $2,400 somewhere. So, we put it in a policy for my granddaughter, Bryn. Now, remember Jim said 4% guaranteed rate of return? That's guaranteed by contract, it's written, it's contractual. Plus the dividend, minus death benefit charges. In today's economic environment, we're earning about 5.5% tax-free. So let's just put 5. Okay, I was 53 at the time, and I thought, well, I'm gonna live at least to age 83, because remember my mom's 84 driving a Mercedes sports car and dancing, right? Okay. So I'm going to live at least 30 years, and I'm going to save $2,400 a year for those 30 years, right? And I want to be honest with my money. So 30 years, that's $167,000. Now, it's not magic. Someone was going to have control over that money. It was either going to be me or USAA Insurance Company. I want it to be me. Now, this is cash value, not death benefit. This is usable money. If I have a claim, every once in a while, can I go pull out $5,500? Yeah? Okay. Now, I pass away, I get to go to heaven. And my granddaughter says, well, I don't want to put $2,400 a year into this anymore. I need another future life combination. So we're just going to let it ride. We're going to stop the payment on it. So 167,426 goes in present value, right? It's just going to sit there and earn at that same 5% rate. See, we're assuming the economy is never going to get better, right? Dividends are never going to go up. Do you know we're in the period of the lowest paying dividends in 170-year history? Wow. The lowest paying dividends. Do you know in the mid-'80s? Remember the mid-'80s? Inflation, blah, blah, blah. You could get a CD, a one-year CD for 11%, but then mortgages were 18. Do you know how much the dividend was in these policies? 13, plus the guarantee.
You're saying that you can stop payment on these anytime you want to start again?
After the second year.
After the second year?
You gotta do it 2 years. If you do it 1 year, it's considered taxable.
And what is the smallest amount that you can start with?
Depends on your age and sex and rating. And there's too many in, I meant male people.
Just sending the details.
And I'm also thinking that, paying your taxes on an IRA may not be as much as you think it is.
That's right.
And you can probably calculate where the payoff for making that exchange into one of your vehicles is worth paying the taxes.
That's what we measure. In fact, when we do that kind of moving qualified plan money, we keep you in the same tax bracket you're in. So we don't really, unless you want to, we don't really advise coming out of your tax bracket. If you're in a 25% tax bracket, then I want to keep you in that bracket. So 25% tax bracket on a married couple filing jointly is about $150,000 you can go up. Okay, and then that bump, the next dollar bumps you into 28% bracket. Okay, so what if you're earning $130,000? Well, see, to my mind, you're leaving money on the table. You're leaving $20,000 at a 25% bracket. Because what happened on January 1st, 2013? All the brackets went up one bracket, right? So see, to my mind, you're leaving money on the table. You're leaving money that you could pull out of a taxable account and pay the tax at your lowest tax bracket you're ever gonna be, which is the one you're in today. But I wouldn't recommend you take your 40,000 out, because then your bracket, thank you guys, then your bracket would be, on 20,000, it would be 28%, okay? So there's lots of strategizing on this, okay? To make it maximally to your benefit. So, 167, we're gonna let it ride, no more premiums, we're gonna shut them off contractually. 5% earnings rate over, my granddaughter's now 30 years old, and let's send her to heaven at age 85. So 55 more years, okay? Future value, $2.4 million. My financial decision to recapture that money generationally ended up giving $2.4 million to my family, tax-free.
I have to say, on the strategy that you're talking about, the biggest problem I feel for most of us is you give us 4 pages of information that you want, and we're like, I don't have 5 hours to find all that. So when you break it down into small bits, and we really get that we need to spend the time and give them the information, the only way that you guys can help us is if you know what's going on
We
in
got
our
another
lives.
story. Yes, sir.
And what I've also heard here and there, in the future of some odd 50 years from now, we'll need at least $2.4 million annual income just to live at the status or the level we're living today.
Well, that's inflation, right? I mean,
Not to mention anything else, yeah.
yeah, when we do retirement planning, how many ravages of retirement of our monies do we have? We have inflation, right? The buying power of our dollar goes down every year, right?
Yep.
Okay, we've got to allot for that in retirement. We have taxes. Taxes are tax law, right?
Yep.
Tax law change all the time. Do you think taxes are going to go up, down, or stay the same right now? Up. Okay, we've got to plan for that, don't we? Okay, what about living too long? Who wants to outlive their money?
I want to outlive 100, that's it.
So nobody wants to be well, they brought Walmart leaders back now, but nobody wants to be a Walmart leader at age 85, do you? It's now a Home Depot leader, by the way. Okay? What about dying too soon?
Nothing wrong with that.
Why would that be an issue in retirement planning? If you're married, dying too soon, what do you lose? Well, you might lose the spouse's Social Security and maybe a spouse's pension, okay, because it's a life-only pension. There's things that you have to consider, making sure that the surviving spouse is taken care of. What about planned obsolescence? What about planned obsolescence? Do you know what that is?
Oh, yeah.
This cell phone,
2 years.
I bought it 2 years. It's actually
3
2
if you
years
push
and
it.
2 months. Because the warranty is 2 years.
Yeah.
Okay? I bought it in April of this year. I know in June of 2017 it's going to quit working. Because there's a timer in here somewhere. And they planned that. And everybody knows what I'm talking about. You guys, I'm not the only one. Okay?
I mean, it's automatically going to stop working.
It's an upgrade. It breaks. It does something.
They design them that way.
The
They
battery's
go,
gonna go
okay,
out,
we
the
need it to
screen's
last
gonna
2
go out.
years with no warranty claim,
Yeah.
and then 6 months after that, if there's a
Exactly what it is.
90% failure rate, fine by us.
The mothership will just upload Windows 10 anyway,
There you go.
right there. I mean, you're sleeping.
Yes, sir.
Go back to that, I missed something there, and I'm not quite getting it. So your granddaughter
We put a policy on her one.
on her, and then she didn't want to pay it, but it was still going. So then she had to have someone else be the beneficiary. Or did she get the money?
No, she didn't get the money unless she canceled the policy, but she would never do that because I teach her, correct?
Okay, but that's a problem that you have to make sure
You
people
have to
don't start
address.
canceling.
But you know something? If you're worried that your drugged up granddaughter is gonna go blow the money,
Yeah.
put it in a trust. And the
That's
trust
where you
dictates
put it in.
how it's used.
Ah,
Okay.
Show that little girl, she's not gonna do this.
Yeah, so then she had that money, and that was without paying any premium.
It's just the time value of money.
Yeah, but she could have paid premium.
Yeah, if she didn't pay
She
it.
could have paid, if she had paid the premium, put $2,400 a year in it.
And then that would have gone to whoever she had it go to.
yes, yes, yes.
Yes, yes, yes.
Yes, so that when I die, the way we have her policy, when I die, she's the contingent owner of her own policy. Okay? Or I could make her mother the contingent owner. And then let's
Who's the
say I made,
beneficiary? Is the beneficiary the?
this is her life, not my
Oh,
life.
oh,
So when I die, it doesn't matter.
oh. Okay,
Because this is not the death benefit on me, it's the death benefit on my granddaughter.
that's right.
Okay? There's 3 parties to the contract. One party is the insured, whose life the policy is written on, my granddaughter Brent. The other party is the owner. Owner means controller of everything, right?
Owner.
God.
You're the one that borrowed.
I am the owner of the policy.
Okay.
It's my money. Then there's the beneficiary. Well, until I die, I'm gonna be my own, I'm gonna be the beneficiary. I want the money back if she dies
Yeah.
first. That's my asset, right?
Got it. Yeah.
And the only way I can get my money back if she dies is to get the death benefit.
So
Right?
in that case, you would cash it out.
Well, it has to cash out
It
because the
has to,
contract
because
is
they
over.
died. Because she's the insured, if the insured dies.
Okay?
Very, yeah, yeah.
Okay. Jim, I don't know how to switch it over.
Well, I have one question.
Okay.
After 14 days of life,
The mouse.
does your daughter, for the purposes of the policy or any other legal reason, need to have a social security number that time?
She does, within 6 months. I have to provide it. I'm trying to get that up back for you. The tax thing. So, you guys still okay?
Yes.
All right,
Yeah.
okay. One of the things, and we have an accountant in the back room, she can verify this, okay? There's another accountant that helped me do this, verify it. By the way, there's 80 places I can find inefficient money in every one of your financial economies. 80
No.
places.
And I would really like to stress and add that they're not charging you money to find that stuff and figure out what's going on. You're gonna eventually get a policy, but the kind they're spending, they're not asking for a credit card, right?
No, we come alongside of you, we work as part of your team. You'll never get a bill or an invoice from us. We don't need to do that, guys. I'm so busy right now that I can't even talk to anybody until September 19th, 22nd
Of this year.
of this year. Yeah. Geez, you're like my husband. Why can't you work any more hours, Becky?
Sorry, I didn't.
You know, the thing about it is this strategy, remember the rich and famous have known about this for over 100 years. Okay? It's just now sifting down to the me's and you's. There are so few of us teaching this.
Yeah.
Yes,
Is
ma'am.
this a 770?
Yes, and if you go to the 770 account, which is the Palm Beach letter, I'm recommended as one of their,
Oh.
yeah.
Well, I came across a YouTube video that talked about 770, and JCPenney used it in the Depression. The same
J.C.
as-
Penney used it?
The same as.
That's right, that's right. But I'm one of 3 insurance professionals that they recommend for the whole, yeah, for their whole subscribers. Yeah, they call it income for life also.
Yeah.
Yeah, okay. So we call it income for life, okay? All right. Remember how a bank makes money? They take your money, they loan it out to someone, right? Remember Jim. Jim pays the bank back, and the bank gives you a little bitty thank you for using your own money. Have they used any of their money in that transaction? No. Okay. Insurance policy, here's you, and here's your company. Okay? You borrow money from the insurance company at 6%. You loan it to your company at 12. Why in the world would you want to loan it at 12? Unless there might be some tax advantages to doing it. Okay? Your company pays you back the 12%, and then you make the loan payment back to the insurance company. Have you used your money? No. Your money's still compounding, right? Uninterrupted.
Well, the insurance, yes.
Are you a wealth creator right here? Yeah.
In a couple of ways.
Okay. But let's look at some of the tax advantages also. So, now this is going to get a little bit complicated. We're trying to use that $30,000 that we use for paying cash, financing it, or using the project reserve. Okay? So, we borrow $30,000 from the insurance company. So we borrow $30,000, right? We loan it to our S Corp LLC at 12%. Now, if we didn't do that, and that's $3,600, 12% of $30,000, the interest only on it is $3,600. Okay? If we did not do it this way, at the end of the year, we would have to take, that company, we would have to take that $3,600 as income, right? It's passed through account, right?
Right.
Doesn't matter how it comes over, but it's going to come over to your personal tax return, right, Karen? Okay. Now, we got to pay taxes on that money. So what if we're in a 30% tax bracket? Well, $1,080 in tax, so we get to spend $2,520. Okay? Now, instead, we borrow $30,000 from the insurance company at 6%. We're going to loan it to our company at 12%. What did that do? I'm just going to use an S Corp as an example. Our K1 is reduced by $3,600, isn't it? Because isn't that $3,600 of interest a write-off in our company? Isn't that a business expense? Okay. So our taxes were reduced by $1,080, right? Okay. But that money, that $3,600, that 12% of the interest, has to come back on Schedule B of our personal tax return. Remember, this is a flow-through account, as investment income. So then we have to pay $1,080 in tax. Okay, so we lowered the tax here and we raised the tax here. All right? But you know that 6% that the insurance company is charging us? On Schedule A, we get to write that off as an interest expense.
Oh.
You can only do this if you use money for a business purpose. Ergo, every money we borrow is for a business purpose, right?
Yeah.
You don't lie, but everything that we do it like this.
Would we need to document anything?
I have all the documentation for you. We don't charge you to do that for you. It's a value added. We have a CPA on staff that you can ask second opinions or tax questions to. We provide all that free of charge.
I mean, they have an explanation for everything we might spend the money on?
No.
No,
Okay, that's what I meant.
no. You can't cheat.
No.
Okay, so let's look at this. Because we got to deduct this $1,800 in our same 30% tax bracket environment, we didn't have to give Uncle Sam $540. Okay?
Right.
So, we have control over $540, and we have control over $3,600, right? Well, that's $4,140 versus $2,520. so you borrowed 300,000. Okay? You see, it doesn't matter which way you spin it. At the end of the day, isn't it how much you get in your pocket to use? Okay.
Would that look if it was a C corp, double taxation?
C Corp is different. Do you want to?
Yeah, I mean, it's not gonna be a flow-through, so that's obviously gonna be a big difference. And my question would be, do you have a C corp?
And an LLC,
Oh, okay.
and you name it.
Okay, okay. So my advice to you would be to do this through those companies that are flow-throughs, because that's where you're gonna get the biggest tax advantage. Because coming from a C corporation, you're not gonna have to flow through benefit anyway.
But Karen, couldn't he personally borrow money from the insurance company?
Sure.
Loan it to his S Corp or LLC?
Yes.
And then the S Corp LLC loan it to the C Corp, and then you would get the same tax advantage.
Sure.
You just have to add that
Sure.
separate layer.
Like her.
You know, but the question would be really and truly,
She's been there.
but the question would be really and truly, is the C corp where your real issue is? And if it is, she needs to take a look at the whole thing.
Right. Yeah, we just-
Because it might not be structured the way it needs to be to give you the optimum benefit to begin with.
We just forward the C corp, and so it's growing and it can change and
Right.
you can guide us.
Right.
So we'll work with you.
Yeah.
I think I may have told this in June, but we worked with a guy that owns a trucking company up in Michigan. He came to me through the Palm Beach letter, the 770 account, okay? And he mentioned that he was a C Corp, and that probably in 4 to 5 years, he would be selling his company. And all sorts of red bells started going on. I'm like, this doesn't sound right. So I called another CPA, and I said, Neil, there's something wrong here, I just don't know what. And he goes, oh my God, you don't want to sell a company if you're a C Corp. Okay? And I said, okay, so we got him on the phone with my client. Bottom line is he sold his company in 2 years, not 4 or 5 like he thought. Instead of him thinking he was gonna get like $3 million for the company, he got $7 million. We saved him $1.3 million in taxes. Wow. Corporate structure, it's important.
Done,
That's
yeah.
why it needs to be looked at,
That's right.
okay?
Combination.
Yeah. And you can have a C and an L. I mean, you just need to know how, yes, absolutely. Okay? So good stuff, right?
Very good.
Good stuff.
Any other questions? Okay, so I have a question. Wants to be a wealthy. So we would like to have Rebecca and I on our team help implement this strategy. Hands, right? Remember Dan said, this is important. We're not gonna send you a bill and invoice to do this, okay? How do we do that? It's kind of crazy for me to say, isn't it? Right. Insurance companies take care of us. Right. Insurance companies like us to go out and talk to people about what we can do. So we don't have to charge you. Right. We can spend 4 hours with you or 40 hours with you. And that might be what it takes, and we're with it, right? Okay. So-
And we're kind of hand selecting our partners, aren't we?
Yeah, exactly.
Because we don't invite everybody to come in and be a part of an insurance company that we're a part of. We want honest people using their money correctly, you know, so that our dividends can be the highest that they can be. You know, and
Karen's gonna pass your card. If you want us to, if you wanna work with us, you want us to call you, we're happy to do that.
Okay,
Name, phone number,
who is it?
email
I didn't
address.
see everyone who raised their hands. I think you raised your
Raise your
hand.
name, yes.
Okay.
If not, that's fine too, actually.
Just pass it out to everybody in case they change their mind later on and decide to.
Actually,
Or they just skip their phone?
We're gonna stick around, we've got, like I said, 8:30, catch a bus, but
that's your buck.
car.
That's right. And you went well, so good.
See you get on Greyhound, I don't know if I'm giving you my money.
opposed to getting hit by a bus.
Yeah.
That's it. Okay, well, I want to thank you, Jim, very much. Thank you. Excellent information. I want to thank Rebecca very much. Thank you, Rebecca.
You're welcome.
And I personally have a lot of excitement about working with you guys and ideas of, what we're going to be doing here. I'm thinking of an IRA that we've got that's Michael and his sisters together that is sitting there doing nothing. And I'm sure there's not going to be much of a tax loss to convert that over because there's very little in there. But, there's a lot of good reasons to do, what they have here. And again, it's not going to cost us anything to learn and move forward. And we'll all get educated enough to the point where we can go, okay, even if I start off with just, the smallest amount and the smallest payment per month, we can grow this and do something with it. So, I think it's great. I want to thank you both for taking the time and coming back to Santa Barbara for a little vacation. Right off business.
Yeah.
Right on.
Wasn't quite 30,000.
Wasn't quite 30,000. And we will be back next month. And in fact, next month we're going to have somebody come in and talk about probate. I mean, what they're talking about here today can help us avoid probate in a big way. Okay? And the person who's coming next month is going to say, well, okay, so if you're working with people who weren't able to avoid probate, and all these properties are sitting there and something needs to be done, he's going to talk to us about how we get our hands on those properties and help those people and make that all happen. So we'll see you back here next month about the same time. Okay?
All right.